Thank you so much for coming, everyone. It's very hard in the summer. No one wants to listen, but they do watch the videos and the live streaming afterwards, we know, because we see the numbers. And also we have some great VCs here tonight. I've known both of them for quite a few years, and I just know that this will be an interesting conversation. I think it's fascinating myself to find out how entrepreneurs can work with investors and how investors can work with entrepreneurs. It's not just an easy situation. There's a relationship there. So I'm really fascinated to hear what the discussion goes to tonight. So I'm going to introduce Abi. He's from IDC, and he's going to introduce the VCs. So I'll give that to you.
Okay.
So go ahead. If you want to talk a little bit about it.
You can go first.
Sure. Sumeet Jain, longtime venture capitalist, was at a firm called CMEA, then Untitled Capital, now started a firm called LUMA Capital Partners. Mostly Series A, Series B focused, focused on the intersection of digital media, marketing, and commerce technologies. Prior to this, spent a number of years at Goldman Sachs as an investment banker, and before that, was an operator at 2 startup companies, so have been on all sorts of different hats, but all centrally focused around software, technology, media, and marketing. Those have always been the core tenets and themes of everything I've ever done and worked on. Based here in San Francisco and have an office in New York, and happy to be here.
Hi, thanks. My name is Sharon Weinbar. I'm a venture partner at Scale Venture Partners, which is a venture firm here in California, invests nationwide, invests in companies that are scaling. So after the company is in revenue, when more money invested means also driving revenue growth and value creation for everybody involved. I've also recently been CEO of a startup myself. It was a bootstrapped company. I didn't have a board, so that'll be interesting to talk about. It was a lonely job. And that company is Hackbright Academy, which is a coding school for women. So we teach women to be software engineers and help her get her first job as a software engineer in the industry. And that company was acquired last year. I still work for Capella Education Company, the company that acquired us. Prior to joining the venture business in 2001, I was a tech executive and operating executive in both public and private companies, including startups in the bubble. And past life, I was a Bain & Company consultant for 5 years.
Right. So I think since this panel is somewhat about helping entrepreneurs understand how they should be working with VCs, perhaps we could start with getting an understanding of what are some of the areas that the two of you look at and focus on for current investments, and what are you looking to do in the future?
Sure, maybe. So personally, where I invested at Scale Venture Partners had a lot of overlap with the areas that Sumeet mentioned. We've crossed paths before, for sure. Mobile and web, digital marketing, media companies. I had several mobile games companies in related spaces. As a firm, Scale Venture Partners currently is focused really on B2B, X as a service, so recurring revenue, selling to businesses, selling either to a line of business executive in enterprise or to engineers. So we have a big practice in software as a service solutions that are used to develop contemporary applications based on lots of API, assembling code from lots of APIs. Again, early in revenue, so the average company is growing. I think the current number is 282% year-on-year growth in the first year after we invest. So it's really in that early adoption phase when you've got product market fit, and it's clear that that customers want to buy what you have to sell. That's the place we like to play. We spend a lot of our time inside the firm kind of understanding the needs of companies in that rapid growth phase and how we can help them.
So these companies already have some investment.
Yeah. Typically, yes, because they have yes. So we're stage agnostic, except we don't do seed rounds. We only lead rounds and take board seats. I would say typically it's a Series B or a C company. We definitely make Series A investments when it's a company that has gained traction on its seed capital. And in about 20% of our companies, we're investing when they're already kind of a later stage company. That depends a lot on the investment cycle. We like to have a mix of some more mature companies and some younger companies. It helps balance out a fund. But there are periods of time when those companies, we find them to be priced out of what we think of rational range to make a return, and we do fewer of them, and there are times when it's a really great time to invest in later stage companies. But the first premise actually is, do you really like the market? Do you want to be in this space, and do you want to be in this space with these people? So those are that comes before anything else.
Thanks.
Yeah, so a lot of overlap, like was mentioned. Areas of focus, intersection of digital media, marketing. In many ways, a lot of the technology that we don't focus are the things that sell directly into the CIO. So that's security, core infrastructure, big data, big databases. Those are a lot of the areas that we're not specialists in. So really more application layer things that sell into sales, marketing, commerce, media. Very similar from a stage perspective. I think of it as single-digit millions of revenue, have achieved that on, no more than single-digit millions of capital. I think, as for all the trends we're all aware of, how much more efficient you can be starting a company, the expectations of what you achieve early on are also greater, and that's, very Moore's law-ish. It's going to keep happening as time goes on. So really, we call it early efficient velocity. So kind of companies that have shown product market fit and are on their path to trying to show a repeatable business model based on their early success, where, from our perspective, single-digit millions of dollars can buy double-digit ownership percentages of companies. That's where we fit.
So very much a growth stage and getting.
Yeah, so I would be cautious because I think of classically, I think when people think growth stage is later. Yeah, it's a lot later. That's what people define it. So but like I said, the expectations have gotten pre-growth, but early. Yeah.
Growing. I mean, this is
Yeah.
it.
Let's
I'm
just-
so sympathetic to you because this stage, which is a really interesting stage for both for companies and investors. So traditionally in venture capital, the Series B round was called the suckers round, right? Because it was the round where before there were very large seed rounds, companies raised a Series A, built the product, got to beta, and then tried to get a markup on the Series A for the Series B, but before they actually had traction. So they would have beta customers who would give good references, but they hadn't actually spent money on it yet. You didn't know, could I hire multiple salespeople each quarter, and those salespeople would become productive in some predictable time frame such that it made sense for me to keep doing it. That's what you want. And a big thing to realize about investing in software companies is that the vast majority of venture capital dollars invested in software companies go to sales and marketing, right? Look at the P&L of any public software company, and you've got 50% of the revenue going to, sales and marketing related things, and 15% to R&D, or, 18% and 12% going to G&A. So you really want the sales and marketing dollars invested and dollars spent to have a good return. Otherwise, you're just, you keep sinking money and hoping that the customer is going to buy it, but they don't, and eventually, you lose money. So that early stage, which I think both Sumeet and I are saying, we're trying to avoid that sucker's bet, but catch the companies that make it through that phase and are showing that early growth. And it's a very difficult place to name, because when you say, so growth has a also historic connotation with late stage passive investment. The company's doing 20 million plus in revenue. It's a firm. The firms that lead those investments are tacking on to some early stage fund and ceding control.
Already grown, because if
Right.
you've only got to 20 million, you've grown.
Yeah.
You couldn't have got to 20 million.
Right. So but the companies, so the companies that are doing one and 1.5 million going to 4 the next year, that's a super exciting place to invest, but it doesn't have a name, right? I mean, it's part of it's the reason why our firm is called Scale, but we often have then qualified as like Scale with an asterisk, early in scaling, right? Not meaning scale, meaning big already, scale meaning the process of growing. Yeah, I respect your marketing.
Yeah, that's right. And but, one thing to add, one of the things I probably articulated was very cautious about the amount of capital a company has raised at the point we've invested, because where we find a lot of companies get it wrong is they raise too much capital and start spending against the sales and marketing expense without knowing how to productively do so. And that causes sort of this evaporation of capital and never actually getting the model quite right.
Right. Which for entrepreneurs, there's a fellow named Mark Lessey, who was the founder of Veritas Software. It's an enterprise software company that merged with Symantec a while ago and then spun back out. But anyway, he now in his retirement, he's a professor at Stanford Business School, and he teaches a class on sales. And before he became a professor, he developed a PowerPoint called "It Always Costs More and Takes Longer." And it was pretty much his perspective on applying, if the manufacturing learning experience curve. So as you exponentially increase the quantity of widgets you've manufactured, the unit cost comes down, right? It doesn't just naturally fall, but volume helps drive down cost. Mark took that concept and applied it to the sales and marketing process in enterprise-facing companies. But similar to manufacturing, it doesn't just naturally happen. And if you can find one of the old versions of this talk, it's really funny because it's so brutally true. You're a startup, the engineers have been working hard, you really believe in your product, you want to take it to market, you've promised your board that you're going to do X millions of dollars, and on a capacity-based planning model, that means you have to hire this, X divided by some number of sales reps who have such and such a quota, and they're going to go out and do all this stuff, and they do that, and nothing happens. And then you have to fire them, then you fire the VP of sales, then you start over, and you raise another round of capital and another set of promises, and it doesn't. And you're in this churn. And so it was all because of that tendency of people to be optimistic about the uptake in the market and the sinkhole of capital that resulted in that led to the development of the concept of a lean startup and the MVP and using that to test market acceptance, right? It's not your core product, but you're using that to see will the other side buy what you're offering to sell, so that you don't waste time hiring a VP of sales and a bunch of salespeople before you know that what you've got is ready.
It's so lean. Yeah, I mean, focus is make the product so lean that you're really testing the basics of demand, right, before you spend anything.
Okay. So I think from your perspective, you somewhat articulated what are some of the criteria you would look for to invest in the startup, into the space, into the size, what stage they are at, and where they'll be going to, where they need to get to. Anything that is so not all the VCs have that exact criteria, right? I mean, from an entrepreneur who may be sitting here in the audience or listening to us online, they may be at different stages and different places. In general, what would be some of the criteria that you think that you would like to talk about or share with the audience so that they can take something away?
I'll start, and I've talked about this many times before, and I remember in business school, you had this notion of these things that you looked at, team and market and, the technology and all this stuff. And I've come to realize that I think all that is hooey. And I think that all that matters, I define it for myself as one thing, which is velocity. And what I mean velocity is not to be interpreted as just sales and revenue velocity, but the things around like what you're building and doing that are just going really fast. And so that could be the product development is happening really fast. And so in a fundraising process, it's never a meeting and you invest. it's multiple meetings over time. And my expectation is what's happened from one to the next, like a lot has happened. A lot has changed. A lot of learnings, improvements, new team members, great hires. If you're in revenue scale, lots of revenue, lots of customers, lots of but there's a lot that the derivative of this is really fast, and it's even more important as all the things we listen to and Moore's law, TED Talk, all that that every new piece of technology now has a luxury of resting on all the existing technology that exists. Right? And so everything needs to be exponential from where we are today, not exponential from where we were a year or 2 or 3 years ago. So the, and now 10 years into venture capital, I think the rate and the speed and the velocity of a company each year has to be faster than the previous year. So that's,
So you think it is getting
so it's, well, I think that, but it's yes and no. It's not that it's harder, it's that, but you also have access to everything that was built up until yesterday, right? And so that includes.
Wasn't that the case 10 years ago?
It was, but that's right. And so you were expected to improve on the velocity from that point, right? And so as that gets faster and faster and faster, the rate has to get faster, faster, faster. So I think of all these other things that we talk about as all being functions of this, which is, you got a great team, and the velocity of how fast you grow that team is really important. Or you got a really great product. Well, the velocity of improvement of that product is really important. So all those things, in my opinion, that's it comes down to that one central thing, and everything else is a function of that. If you're a great entrepreneur and a great leader, which everyone broadly Silicon Valley talks about, it's all about the team, and I agree it is. But I think the way I look at that is how fast that person's moving.
Attract talent. Yeah. So maybe I'll give a construct that's slightly different. I mean, I think what you just provided is a really interesting overlay and a different on a kind of a different plane of thinking. But I've run IR in 2 public companies, and when you talk to investors, when you talk to institutional investors, there's only 4 key messages that you really want to talk about, and I think the same is true in startups, but the emphasis is very different. So, the plot line of every investing pitch on the planet should be: our market is large, we have a differentiated strategy, our business model makes or will make money, we have the right team to pursue this opportunity, right? So those are the 4 key elements of an investor pitch, whether you are Microsoft or whether you are a raw startup. If you're a raw startup, maybe you're creating a market that doesn't yet exist. So you're talking about total addressable market. It's not yet served. So you're trying to make analogies for how big it is. You're talking about your strategy, which is highly related to the team. And I think in early stage companies, when people say team is everything, that's because that's all there is. You're backing 2 people. I'm not going to say guys, 2 people in a PowerPoint. All you're backing is you're trusting those individuals that and what I'm looking for is what gives you the right to take money from other people's money, OPM, and pursue this opportunity, right? Why do you have a unique insight that's going to let you get differential traction and scale versus a bunch of big incumbents that are going after the same space with the same customer dollars? So, what about it? Your background? How do you know these customers? How do you know this technology? Where are you coming from that makes you and your team uniquely able to go after this? And then, are you a magnet for talent? Right, and that's what Sumeet is talking about. The ability to scale your team. And one of the questions I get all the time in events like this, where you have companies that are not yet funded, right? Entrepreneurs who have ideas and maybe have even formed a company, but not yet funded. And how do I crack the chicken and egg problem? How do I build a team if I don't have money? I don't have money to hire, and because I don't have money yet, when I ask to hire somebody, he or she is asking for an above market salary because they don't trust. And I'm going to say, I'm sorry, but I have a really harsh answer to that, which is if you can't attract talent to your idea, maybe it's not an idea that deserves funding, right? Or maybe you're not the right person to earn the funding. And that's a harsh way of looking at it. But if you have unique insight in the market, it's compelling, you're deeply steeped in the space. You know the engineers who are working on this problem, or you know the customers in this space, right? You've been to the meetups in this domain. Sell your vision and idea, and you'll find like-minded people who want to join you as co-founders. That's the number one test. If you can't attract co-founders, how are you going to attract a VP of engineering? How are you going to attract a VP of sales? How are you going to hire the nth person? You have to be a magnet for talent.
I want to riff on that too, which is that you might meet a new entrepreneur team for the first time, and I have the exact same thought typically, and I think most people do in the community, but which is, hey, you have an entire career of people who've worked with you, who know you and trust you. You have family, you have friends, and I've actually funded somebody whose co-founder was a cousin of theirs. Great, they know you really well, you know each other, right? But there's an entire community of people who know you 100 times better than I will, and if you can't convince them on your vision and on your strategy and what you're doing, then like, what are you doing talking to me? Right? Convince the people who know you best first, right?
So back to somewhat relating to what we are trying to help the investors. You're supposed to have passed that stage. Okay? Let's assume that they have done their homework and they come up meet that bar. What would be some of the things that they should be doing to work with a VC like you? What would you be looking for in them elevating you or showing after that?
So there's a big of a stage element here, right? And so
We were talking about the initial stage.
Yes.
Can you even attract somebody to work with you?
right. So
Got past that stage.
you know,
Something you should already have some traction.
yeah, and I think from there,
And now you're looking for that money.
yeah. So in my opinion, the next thing you need is customers,
Okay.
and sometimes even before product, right? Which is the basic minimal thing that you can deliver to get customers. And so the next thing that I want to see is that
So could that be sort of a chicken and egg thing where they come to you and say, okay, if I have some money, then I can get the customer or the revenue? Or
it's the same thing. Again, if you're a great salesperson, if you're and you've got some good, and you're in an industry where you deserve to be in that industry, i.e., you have expertise, insight, you have something to offer, then that's your place to be building product, to be finding a way, right? And again, this isn't, starting a company is hard, and it gets harder in many ways, and so it's not meant for everyone, and that's okay, right? So, but I do think that in many ways, a lot of the entrepreneurs come out of an industry where they have some expertise and have people who will be their first customers and be their first reference of customers. In many ways, your first customers is how you first get funded, where you get your first capital from somebody who trusts you. And there's many companies.
Or you pull the old-fashioned bootstrapping phase, which is you find a customer, do a project for them, and turn that
Totally.
into a product.
That's right. And that's, in many ways how we started the venture fund. Is started off as consulting for companies who became investors in the fund, right? And that's the same old bootstrapping thing that you do.
So you probably see, how many business plans do you see a week?
We evaluate it.
Yeah.
Yeah.
Yeah, well, we don't think of it in terms of weeks, but we look at, as a firm, we look at about 1,200 deals a year.
Okay.
So for any individual partner, it's typically a couple hundred a year.
That's a
So,
lot.
yeah.
That's a
Yeah,
lot.
I mean, that doesn't
I mean,
mean that
if
you're
you divide
taking a
that by
meeting.
52
It
and
doesn't,
you get a
right,
very
right.
good
It doesn't,
average,
yes,
right?
exactly. So 4 or 5 a year,
Well, it's really
a
it's
week.
lot.
You're, I mean, it doesn't mean we're taking a meeting with every one of those
Sure,
companies,
sure,
right? And that's, I think that's one of the things that entrepreneurs have to understand about VCs is we have two big assets, money and time, and we have to figure out how to invest both of them, and you really have to invest your time to figure out how to invest the money. And so you might have a great idea, potentially a great idea, or it might be an actual proven a great idea, but it might not be in a place where I've decided to invest my time. And so then if you approach me, couple things can happen. You can be so far out of my domain that that my thought bubble is, why did you contact me, right? I don't do med devices. I don't do real estate deals. I don't do slate financings for films, all of which I get multiple pitches for a month.
So
But
message
is
is
it, so
do
number
your
one,
homework before
do
you-
your homework and, approach, the biggest thing is approach VC, thank you. Approach VCs who are likely to buy what you have to sell, right? You have to sell equity in a company that's going after a specific market at a specific stage. Find the people who specialize in that market and that stage, and then ideally somebody who's had success in an analogous company, because number one, they've had success in the market, they'll want to come back for more. Number two, we'll know what we're doing. We'll have domain expertise that we can bring to help you. And if if you're a close but no cigar, so to speak, with your company relative to where I've chosen to spend my time looking at companies, then I have to think, am I better off setting aside the project I was working on, getting smart on place X or doing due diligence on company Y, in order to look at your company? So it has to be super compelling. And the thing that usually will get investors to take a second look at something that's a little bit off the beaten path is awesome traction, right? The velocity. When the velocity is really high, you think, I didn't think about that space, but maybe I should, because it looks like something really good's happening there, right? We have to be open to the possibility that we were wrong in how we decided to allocate our time and dynamically reallocate it to something else that could be better.
So I guess then they don't necessarily have to feel constrained about what you have invested in before.
No,
I mean, somewhat in the same
you,
space,
I,
right?
yeah,
Real
there's,
estate, for example,
right,
is
you have to
slightly
be,
worse, right?
yeah, I mean, it should be,
Somewhat related.
look at the person, are they, what stage are they generally investing in, right? What sectors, if it's all B2B or all infrastructure and you've got a consumer mobile app, that's not likely. And if they do invest in you, it's probably not going to be successful. They're not going to be good at choosing, and they're not going to be good at helping
It's
you,
not a good
right?
match.
Yeah. So I would say, domain and stage are the most important things to do your first screen.
Okay. So, yeah, anything you'd like
No,
to-
that was good.
So suppose they got past that screen and you're talking to them, you've looked at their business plan. What are some of the mistakes you see that maybe that, or doing things that end up happening because of which you didn't end up investing in them?
Yeah, I mean,
Or
so
what are the
so
right things
so the
you
big
should be
thing,
doing
so
after
big
your raise?
and big picture, the average holding period in venture capital is 9 years. Okay, if we make an investment, we're going to be in business together for a really long time. The entrepreneur has to think about it that way, and the entrepreneur in choosing an investor is picking his or her boss, but it's a boss that he, can't fire, right? The investor can fire the entrepreneur, but not the opposite way. So the most important thing is to have a really high level of trust and aligned value systems and aligned vision for where you think the company is going to go, and that each of you have trust that you're going to act rationally when you get information that's adverse to that vision, right? Because not every, you don't take one shot and it goes and it's smooth sailing forever on either side. So every interaction is evaluative, from the first email to the first screening phone call to all the dinners, and the way you react to the way the entrepreneur should be thinking about what is the first term sheet that a VC lays down, and is this person acting in a way that's honorable, and vice versa. And so every step of the process is evaluative. That also means that every interaction, every cycle, we're looking for data. That's exactly what Sumeet said. I'm looking for, what did you say? I'm looking for velocity, right? So if you say, I'm going to close this many sales in this quarter, do that, or do that plus 10%, right? You have to meet the expectations that you're laying out, because that's what reinforces the level of trust, and also proves that the company is on the path that it asserts it's on. So one of the key mistakes is people being overly bullish about what is possible, and having expectations that are disconnected from reality, right? I've seen pitches from entrepreneurs where, They're saying within 3 years it's going to be $100 million and a 65% operating margin. You're like, interesting. Okay, Google maxed out at a 65% operating margin at like about the $10 billion in sales mark, but that took them several years, and very few companies go from 0 to 100 million in 3 years, especially not with that kind of profitability, right? What business experience gave you, where did you read business experience that's going to let you make a model like that, right? Well, and they're like, well, this is the way it passes out. Yeah, so that passes, that it doesn't pass the and it passes like it passes the credibility. You are out to lunch if you propose something like that.
I guess I'd add maybe two things. So, one is the appropriate amount of follow up at the right time, and what I mean by that is I think a lot of people skew one way or the other, which is the way too aggressive and the slow it down, bro. Again, like give me a minute to think about it, and I'll get back to you, or the opposite, which is, we talked about a few things. I'm going to follow up with you asked for a sales projection and 2 weeks later it's that and it's like, did you really just make this after the meeting, right? And is that really how, and so I think that those things are very easy to sense, and those things are very easy, like just very easy to kind of completely make you uncomfortable with that scenario. I think the other thing is that we generally we have a lot of breadth in the things we cover, and so the worst thing is for me to think that I know more about your company, your business than you do, and so I think a lot of people end up being unprepared, where you ask them about a particular competitor or a strategy of a big company. They don't know the competitor. They haven't, and when that happens, you're all of a sudden in my mind, you think, there's no way I should know more about this business than this person does, because I might have read something in Time magazine 6 months ago that gave me this information, and if you don't know everything about it, then I don't have any confidence. They should know 100 times more than me, because that's all they do, morning to night and overnight, right?
Right. No, so I completely agree with that. But I will say that it doesn't mean that you have to have, memorized every fact. And you're right. You have to run your business, and and you're going to have less instrumentation and fewer reports when you're a younger company than when you're a more mature company. And investors are often, we will often ask you, if we're in active due diligence, right? We have come back to you with a list of things we want to understand about your business. We're often going to be asking you for reports that are things that you should know, and you probably should, but you're kind of like, you should know them soon. And so what happens, what we're looking for in those interactions is, we'll ask for, it's in whatever early stage, some company with something as a service, what is your cohort retention rate? And and a answer is a bad answer, and I don't know that I don't know the answer exactly the way you've asked it, but that's a great question. I understand why you're asking it, and let me follow up, right? And so go back and run the report and bring the data. Or we look at it slightly differently. This is the way we look at it. Is this a sufficient answer? But what we're...
I haven't thought about cohorts. Right?
Right. Yeah, what's a cohort is a bad answer. So we're looking for two things. We're looking for the actual data, and is the data good? But we're also looking for how good is your business judgment? Do you get why we're asking the questions? Maybe you think we're out to lunch, in which case you shouldn't do business with us. But we're looking for, do you understand your business? Do you understand the kinds of questions we're asking for? Because what we're trying to get at is, is the company going to grow? Is the company going to grow in a sufficiently capital efficient manner that we can all make money, right? We don't want to just make, because for VCs to make money, really, the entrepreneurs have to make a lot of money too, right? We're not going to make money on structure. So what we really want is that the company is going to be worth a lot more money than gets invested in it. And that means, good things have to be happening, and they have to be happening at a better and better rate. So, so the cohorts from 2018 are better than the cohorts from 2017 are better than the cohorts from 2016. And I mean that in an analogous kind of way. You know, I mean that in certain companies, that's the kind of analysis you do. In other companies, you do a different kind of analysis. But that's what we're looking for.
So what would be a typical interaction period and perhaps number of interactions when you do complete your due diligence? Does it vary quite a bit, or?
I mean, I think.
I don't know. Either one of you.
I mean, it's an incredibly steep funnel, which is to say there's a lot of stuff that you'll look at, a significantly number of first meetings, a much smaller, you know, so this is not a, you know, I don't want to go back to elementary school math. This is like a very tight isosceles triangle, right? It's a very, very, it gets steep very, very quickly. I think by the time you get through the end, you might have spent 40 hours together, right? Like a lot of time. Maybe I'm exaggerating a little bit, but between, hey, well, let's do technical diligence. I think there's a lot of time you spend outside of direct, which is there's a lot of referencing, an enormous amount, and so of everyone on the team, right? And you're not, and it's, I always tell people, we want to talk to everyone you've worked for and with in the past, and make sure this is the best possible team to execute against this plan. So there's a lot of, that's not direct interaction, but a lot of work you're doing around the investment as a whole.
So do you
my
process,
yeah.
from an entrepreneur perspective, what are the things they should be doing to help you in that process?
Yeah, so I would, one of the things that I tell young companies is, ask a friend who's who's raised capital, or at some point in time, and look at all the documents they've produced, like everything that they've produced over time, and make sure you have at least one of those.
For example,
Make sure you have a good cohort analysis. Make sure you've got, a bottoms-up and a tops-down financial model, right? Make sure you've, make sure you've got detailed bios of your teams,
things that a VC would expect
all that stuff,
to-
just so that you're starting there, right? And then you've got that stuff ready to go, and then you're like, and you show up much more
So
prepared.
you don't find surprises in your business. You don't want to find surprises in your business before the investor finds it.
Right. Exactly. That's right too.
Because you want to front run the news. There might be a surprise. It might be okay, but you want to be able to explain why it's okay.
Yeah.
All right, so let's get to the point.
But-
Okay, yeah. go
Yeah,
ahead. If
I
you-
mean,
yeah.
Go ahead.
So I would say in a relatively normal environment, meaning not like super hyped up 2014 market, first meeting to term sheet, if a company is in a space we like, so we have a running start, meaning we already know we already think we like the market, we're looking for this kind of company. You're looking at 4 to 6 weeks from first meeting to a term sheet, right? With many hours of work. Sometimes there's just elapsed time that's not work time, but we spend a ton of time on customer references and a ton of time on off-list references, both customer and references on the team, right? We want to know what, not your hand-picked list of 5 people to talk to, but other people, right? Our job's not done till we found the bad references. Everybody has some, every product has some. That's our job, because we want to know when we're forming a partnership together for the next 9 years, what is it going to be like, and how can I be helpful when I join your board? What do I have to know? What are the things we have to work on together? So that takes a fair amount of time. One thing I think entrepreneurs don't understand that you should just really get is if you have a first meeting with somebody and within the next day or two the investor hasn't called you back with a request for a follow-up meeting, we're just not interested, right? And unfortunately we're maybe being too rude to follow up with you, or we can't, for some reason we can't face the meeting, or we're having to prioritize other things. But that hope of, they haven't said no yet. If a week has gone by, we've essentially said no, but we just haven't told you. And you might.
48 hours.
Yeah,
48
yes.
hours in general with customer sales, and same thing. You have 48 hours.
Right. And the companies that I'm in love with, companies that I think I might be in love with, I set the follow-up meeting before the first meeting ends, right? Because I want to make sure I can suck up their time before Sumeet wants to suck up their time, right? I want to get on your
That's more
calendar.
like a competition
Right,
between
right.
you.
No, because I know it's a good, it's a good company. Other people are going to want to invest. If you're an entrepreneur and you're running a financing process, and it's potentially a difficult financing process, you might actually want to let those sleeping dogs lie and not provoke a no answer. Because then you can credibly say to other investors, I'm talking to other, you never name the other investors, by the way, right? But you can credibly say, I'm talking to several other funds. Now, you might be talking to them and they aren't talking back to you, but you you have a plausible story.
You're right. I mean,
how much
so I would be, personally, I'm a little more cautious there because it doesn't. I think there's a lot of talking that goes on, as we all know, right? And so you also sometimes be cautious if you don't want to, someone's going to call someone and you'll get someone else's story of why you're right. And this happened to me many times where it's like, you're right. I actually am not interested. I just forgot to tell them no. And I don't know. The whole velocity thing applies to fundraising as well. And when you start to hear
They're still in market.
there's still a market and this deal is has lost steam, you might have been really excited, and all of a sudden you're like, I don't have to hurry, right? It's just the reality of what happens. So, yeah.
All right, so let's move a step further.
Yeah.
You've got to the term sheet.
Oh, I want to say one important thing. Sorry, on the last question about what to expect.
I was just going through
No, and sorry, because there was something in my head that I wanted to make sure that when someone gets further along in their diligence, I think it's not true you should expect it to be mutual. And I certainly, at a minimum, I give a list of every single company I've ever been on the board of, every company I've ever invested in, with every email and phone number of everyone, even the deals that have not gone well, and do all that stuff too. And I try to point out, like, this is a company that didn't do well, and we got into this with the CEO. But call him and see how it went down, and see if he's still my friend at the end of it, etc. So I think that's really important to do as well, from the other perspective, where if someone's getting involved in doing some diligence, then I think it's important for the entrepreneur to do that as well, because it is a 9-year relationship.
That's a good point. Okay, so let's get to that first term sheet and going forward. What are some of the things that entrepreneurs should keep in mind after that point?
So I think there's only been one deal in my career that post-term sheet didn't consummate, and that was because the company had a pretty significant miss against their plan during that quarter. And
What was that?
no, I mean, so let's say first meeting, the term sheet's called 6, 7, 8 weeks, and then it's maybe another 3, 4 weeks to close. And so it goes back to all of a sudden the credibility of what they presented was intangible. And so when I was an investment banker, the company missed. They missed their sales target, right? And I remember, we had this concept when I was an investment banker, when I was at Goldman Sachs, it's the bring down diligence call, which is you do one last set of the entire set of diligence before you close everything. Let's look at the sales fund. Let's look at it, and you spend.
What you're saying is basically that it should be pretty smooth sailing
It should be.
after the.
Yeah, I would think some of it's legal. I mean, I would say I think most of the credible venture capitalists, when you issued a term sheet, you have full expectation to close, unless there's something material that changes.
Something unexpected.
Something unexpected.
Right.
How about you, Sharon?
Yeah. So I would say, this is a place where private equity style investing and venture capital investing is very different. So venture capital investing, usually you've done your business due diligence up front. There's legal and financial due diligence that comes after the term sheet. That we are still looking. You sign the term sheet with the expectation you are going to close unless you find something adverse, right? I mean, I think in our firm's history, I know of 2 deals we didn't close after term sheet. One where there was a huge intellectual property issue. In fact, the existing investors ended up walking away from the company. And the second was a term sheet I signed that was a scrappy bootstrap startup that just the entrepreneur refused to invest in legal, and he had issued things that he called promissory options. So there basically was not a known cap table, and it was
these are
not. Yeah, so they're weird corner cases. The more important thing, I'll say, the one investment I made that I truly regret making, meaning I have lost money in plenty of companies, but there's one investment I truly regret making, and it was where, after signing the term sheet, there are other things you negotiate. So you're negotiating, in some cases, founder vesting, entrepreneur employment agreements, things like this. The entrepreneur asked for an incredibly outlandish employment agreement after we'd signed the term sheet and before we closed. And I'm like, and personally, my negotiating style is, I'm going to tell you what I think is fair. I'm going to tell you the return multiple I'm trying to make. I'm going to give you my financial model, my investment model that shows how I think the company is going to grow, what I think it's going to be worth, the range I think it'll be worth at time of exit, how that rolls back to how much I can pay now, and I'm going to put a term sheet on the table for that amount. And and we're going to, I think we'll be nibbling around the edges, but I'm not a negotiator that I'm going to bid half of that, expecting to creep up and get a deal, and neither do I expect the other person to be that same way. This fellow entrepreneur, who shall not be named, said, and I said, I don't, this is not the way I do business. And he said, I want to put a gun to your head that's going to make it so painful for you to ever fire me that you're never going to do it. And I'm like, if you,
He actually said that?
he did say that. And and my stupid mistake was closing the deal. That was my mistake.
Sure. Yeah, so let's
Yeah, in retrospect, it's really obvious. And in the moment, you have momentum. You've spent a bunch of social capital, convincing your partners you want to do the deal.
Sure.
Yeah.
I mean, I'll give you, my story, if there's one deal that I regret, and it was basically, do you know the term party round? It's sort of it's the notion of a whole bunch of investors are all putting in a little bit of money. It's called a party round because it's sort of a party.
There's no lead.
So because there's no lead, no one's, if everyone loses a little bit of money, no one needs to spend that much effort on it. And in this case, I was asking for a bunch of things, both legal and otherwise, and it was just like, no one else wants it, no one else needs it. If you're going to need it, you can get out. And I'm like, fine. And it was more than that. And we need those things, because that's exactly what blew up, right? It was just,
So
yeah.
in the interest of time, I have two more questions. First, what are some of your top expectations from entrepreneurs that you have actually invested in? And number two, what are some of the incorrect expectations that entrepreneurs have from people like you,
And
after they've
sorry to interrupt. We also need to include 15 minutes of Q&A. So
Okay. Yeah,
So
if
if
you
we
just
can
answer
make
those
those
two
answers.
quickly, and did you get that, those two, or do you want your expectations from the entrepreneurs after you've invested in them, and some of the wrong expectations that the people you have invested in have from you?
Yeah.
They've got the money, everything is going, but they have some wrong expectations of what the VC.
Right. I mean, so the expectations are, we're going to make a plan. We're going to make a plan together, right? Meaning you're going to make a plan. The board is going to approve a financial plan. We talk about our shared expectations, and we track how we're doing versus those expectations in a rational, data-driven way. And if necessary, we adjust expectations, right? So the big thing is, you're working, you're planning, you're executing. And I will say, I think now, having been in the entrepreneur side, the thing you have to recognize is entrepreneurs have to be simultaneously super hot and cold. And what I mean by that is the entrepreneur has to have huge velocity, right? Rocket ships get really hot. You're crushing it. You're going to do this. You're working really hard. You're hiring people. You're selling the vision. You're out generating heat. And at the same time, what I need from you as a board member is that you have a coldly critical eye for the facts of your market and your business, right? These customers are or are not buying. This product does or does not work. My head of sales is or is not making plan, and now I have a plan to deal with it. So it's a very yin-yang experience to lead a company. as an entrepreneur, you need an investor who's going to recognize that, but you also have to recognize it and not always be in sales mode, right? If you're always in hot mode, I'm going to think you're clueless. And if you're always coldly calculating, I mean, there's, almost every company has all kinds of words, right? So you have to be able to have the heat that attracts people. So that's the expectation. The thing I think people get wrong is, like I said, that switch. You're on one side but not the other, and usually it's the hot side. And so that, I think that's where people get especially really wrong, is when you can't adjust to changing circumstances.
So maybe it's a similar way to say it, but I think there's two sides. There's a passion, and then there's sort of a data-driven honesty, and I think the expectation is that you have a healthy balance of the two. That there is a lot of things that you have passion over, and then you have a data-driven honesty around that about whatever it is, a person on the team, etc., and you approach those equally. And when you find the data-driven honesty, you smash the passion behind it. And when you don't find that, you hold the brakes. And so I've seen both sides of that, where, someone's got too passionate about a particular sub-business within their business. One of my favorite CEOs ever, and it took 3 board meetings to get him to shut that business down, where it should have happened 2 board meetings prior. But otherwise, super very, very honest, straightforward, and in many ways. So I think that's an expectation of just of that, and also just generally no surprises.
They having expectations.
Yeah. So I think one of the expectations that is incorrect is that there's always capital available from existing investors or from the outside world or from wherever it is. That, raised capital, hence there's more of it. There's more of it. And the reality is it gets harder and harder. And so the metric, everything gets harder as well. So I think that's a missed expectation, or, I'm so close. Can't we? Yeah, no. I mean, it depends. And I know in my, the first few years of being a young venture capitalist as a associate and principal, I definitely had that gut a lot of times. And I'm glad the partners I worked with said, you know what? No more. Yeah, exactly. But that was a great learning for me, right?
That's good. I think we should give some time for the audience to ask some questions.
So you talk about due diligence to do with the entrepreneurs, right? And what happens is after you do all this, still a company fails. You've gone through the whole process of going through the person, you've gone along with them, and you're doing business with them, and you're going to one and spend like 3, 4 board meetings, but still it fails. So, I mean, where does the gap arises?
You're like, we're not future, we're not fortune tellers. And I mean, yeah. So the question was, hey, you do a bunch of due diligence, you start a business, you invested, and it still fails. And I say, that's welcome to Silicon Valley, right? That's the, and in general, like, I often think of Silicon Valley as like, let's assume this is Silicon Valley Inc., and we're all just one individual business unit in it, and a business unit dies. What do? You get a job at another business unit within Silicon Valley Inc. And that's the way I think of this entire ecosystem. Is it's not, it's just one massive thing, and just like Amazon or Google have 1,000 projects, some die. If it dies, the general manager of that business unit starts a new business unit or joins another one. That's what happens here. You might start a company. We might use all the intelligence in the world that we have to try to predict, and if it works, awesome. If it doesn't work, oh well, just move on to the next thing within the entire, thing.
So, yeah, like the song, 50 Ways to Leave Your Lover, there's a lot of ways that companies can die. I mean, usually companies die because they don't have enough revenue to cover expenses, right? If you can make revenue, if you can make gross margin, you can cover expenses and you can stay alive.
Yeah,
You
but
may not.
From an entrepreneur's perspective, they're trying to show you that, we'll make the revenue, we'll get it there. How do
but you have
go
to-
about
but-
assessing all of that.
Yeah, but his question was, I think, after you've made the investment, how can a company die after after you've made the investment. They die because they run out of money. And so if you have a way to not need the VC money, you have a way of staying alive. You might even get your company back. You might even get your ownership stake back from the entrepreneurs if you're willing to bootstrap and the entrepreneurs aren't willing to invest. There's a really interesting study out. I want to say it was done by CB Insights, but I'm not sure, that literally detailed out 232, I think, ways that companies died. So they interviewed all these entrepreneurs and did a little case study on literally hundreds of recent tech startups and what had caused them to go out of business. And it's just, I mean, it's not like watching a train wreck, but it's just, it's an interesting learning. There's so many cases where the entrepreneurs didn't get along together, or product feature was supposed to be a big hit and it wasn't. There's just, there's a handful of big core reasons why companies fail to reach scale such that they can at least become, cash neutral. If you can get to cash neutral, you can tread water and you can find some other way.
So does that answer the question? Okay, great. Another question?
Yeah, so how much of the work you do as an investor is followed on by some sort of advisory or coaching role with the founders as they're going through their own personal and professional development to grow their business? Or is it more that you're like hands off and you're like you come to you and they step in the food pile and and they got people in their food issues and they come and talk to you about it, or you just wait for them to go up their neck?
No, okay. So the question is how, what's the relationship like with an investor? So I think both of us are with firms that are what are called active investors, meaning we lead rounds and we take board seats. And so when an investor joins your board, first of all, the investor has a duty of loyalty to the company and to all of the shareholders. So we're there in a seat that was purchased by a round of preferred stock, but our duty as a director is to the entire company, which also means our duty is not necessarily to the entrepreneur personally. And I would say that's one of the things that entrepreneurs sometimes have a wrong impression. I once have a portfolio company where I had been talking with the entrepreneur for a long time. I think we need to change leadership. And when I finally sat down for breakfast with him in a restaurant and said, I think we should start a CEO search, he stood up in the restaurant and screamed at me, quote, I thought you were my friend. I thought you were going to help me. You liar, right? And so he was, so it actually validated my point of view. Yeah. But the mistake was he thought I was his friend, right? And he hadn't been listening. Now, our jobs are so much easier and we make so much more money when the entrepreneur is successful. And we've expended a lot of energy. We want the entrepreneur to be successful. I have companies where I've had a board meeting. I had one company where I had a board meeting every single day in December, including Christmas and Christmas Eve, because we were really close on cash. Now, we made it through the knothole and ended up selling the company. But you have companies where you have daily cash calls with your company because there's not an infinite supply of money, and you want to see them through, right? So entrepreneurs who run companies for many years have to get multiple personality transplants along the way, right? What the skill set to run a 10-person company, a 100-person company, a 1,000-person company are very different. And we want you to develop those skills. We're going to help bring you experience. We're going to help find other board members. We're going to help share other portfolio companies' experience. We want you to be successful, but you also have to do it.
One of my early venture mentors, one very well-known venture capitalist, one of the pieces of advice he gave me was, the first board meeting, you have to make a decision. Is this the right CEO and do you have trust in them? If the answer to that is no, then you have to start thinking about who that should be. If the answer is yes, use every board meeting to figure out one thing you can do to help that CEO between that board meeting and the next board meeting. And that's sort of how I've always operated, which is, and so not necessarily day-to-day hands-on, but I'll take on a project that I want to execute between board meeting in those 2 to 3 months. And that project can be as simple as, hey, I really need to know I'd like to get to know the CEO of General Motors, and I might not know him, but I'll find a way to get to that person. Or that project might be, we need some data on this. Is there someone, whatever it is. But that's sort of how I've operated. In my opinion, if board members and investors start to get more involved, it's probably not a good sign, right? It's probably, you kind of want to be, helping the CEO guide and steer, not doing the steering and guiding yourselves.
So, any last closing thoughts? Oh, we have one question.
What would you pick as the biggest criteria for scale up? Being magnet for talent sounds always good at every stage of the company, but especially for the company with some revenue. When you're looking at the company, when you're looking for the company with some revenue for biggest scale up potential, what would be the most important thing that you have to look at, if any?
I think there's a lot of things. I guess I'd simplify it to what I said earlier, which is I think customers solve all. Customers give you revenue. Revenue gets you to break even. Customers get you capital to hire new employees, to hire a team. Great customers are great references for new customers. So
Then you have to interview customers, not the employee, because customers know what they
and that's a big part of the process. Yeah, that's right. That's right.
Okay, great. Thank you. Thank you so much. Thank you.
Thanks so much, guys. That was fantastic. I learnt lots, even though I've been around for many years. Would you guys like to take a seat? Because we're going to have one pitch, if that's okay. No judging. You can just relax and enjoy yourselves.